Imagine this. You're planning to retire early, not in 10 years or 30, but preferably in the next few. Your goal is income, weekly income, to replace your current paycheck. Could ULTY be the ETF that makes it happen? ULTY is the YieldMax Ultra Option Income Strategy ETF, and it is terrifyingly effective at generating income. As of now, the ETF is paying roughly 10 cents per share per week, and that's consistently paid for weeks in July 2025. With a share price hovering around $6.12, that puts its trailing 12-month distribution rate at about 85.9%. This yield is real, not speculation. The ETF's assets under management have surged rapidly. It now manages approximately $2.64 billion in AUM, up from just a few hundred million earlier this year, according to ETF database and investment platform data. That scale matters because it means liquidity is healthy, and investors clearly trust it. Let's run some numbers. If you invested $100,000 into ULTY at a price of $6.12, you'd own roughly 16,340 shares. At a weekly payout of 10 cents, that translates to $1,634 a week, or about $85,000 in annual passive income, assuming distributions continue at this rate. That income alone is enough to replace many full-time salaries. But can ULTY actually support early retirement? The quick answer is maybe, but only if you're aware of the trade-offs. First, understand ULTY's strategy. It holds a basket of about 118 U.S. large-cap stocks and writes covered calls on them to generate option premium income. That premium becomes your weekly cash flow. Still, this also caps any upside. If the underlying stocks soar dramatically, ULTY won't participate fully. Your income stays fixed per week, while you sacrifice some capital gains. Another consideration is composition. Distributions often include return of capital ROC in addition to option income. ROC isn't taxable as income now, but it reduces your cost basis for tax purposes, and repeated ROC can erode principal over time. Another thing to monitor, volatility. ULTY thrives in choppy sideways markets. When volatility is high, option premiums are richer, so weekly payouts stay elevated. In quiet markets, premiums dry up, yields shrink, and the cash flow can compress rapidly. Plus, you're drawing cash flow from NAV. If ULTY's share price declines because NAV shrinks or because premiums drop, even if you're pocketing weekly income, your principal might decline over time. If NAV drops 8 to 10% in a year, that eats into total return unless offset by income. Still, there's a real use case here. Suppose you need $3,000 per month to live. At the current yield, a $100,000 investment in ULTY provides more than twice that cash flow. Even $500,000 could support a $30,000 per year lifestyle solely with ULTY income. If you're growing that pool or reinvesting dividends, compounding can make this work sustainably, at least for a while. To reduce risk, many income-minded investors pair ULTY with more traditional equity ETFs like VTI or SCHD. These provide growth and diversification, while ULTY provides a weekly income sleeve. That setup reduces reliance on one fund and helps offset any NAV erosion. Let me also mention liquidity. It's not a problem for ULTY. With over $2.6 billion in AUM and average trading volumes in the tens of millions of shares, selling $10,000 worth doesn't move the market. That's important when cash flow is tied to the ability to rebalance or exit. Performance year to date, ULTY's total return is around 25%, driven mostly by income. But its NAV has stayed flat or slightly negative, showcasing that most of the return comes from distributions, not price appreciation. Buy this fund to build income, not ride market rallies. The upside is capped. In a bull run, you'll underperform index funds. But in flat or attribute-heavy regimes, you'll shine, because you collect options income consistently regardless of share price. ULTY's yield is eye-catching but not guaranteed. As of 5th August 2025, the distribution rate is 85.93%, but next month it could drop if volatility softens. The fund's 30-day SEC yield, which reflects actual investment income excluding option premium, is currently 0%. That means all the yield is derived from options and ROC. This is vital to understand. So here's the bottom line. Yes, ULTY can support early retirement if you're disciplined, diversified, and tax smart. But use it wisely. Don't pull out too much too fast. Offset risk with growth assets, monitor your effective yield after taxes, and treat distributions as a paycheck more than a long-term growth engine. If you're in the 30s or early 40s, chasing cash flow instead of growth, ULTI gives you a tool to fast-track lifestyle income with as little as $100,000 to $150,000, depending on your spending. But if you're younger and focused on wealth accumulation, consider a blended strategy. ULTY is not magic. It's powerful, complex, and not without risk. But for income investors who understand the mechanics, it's one of the most plausible weekly paying ETFs available in 2025. If you found this breakdown helpful, hit the like button and subscribe to Money Stick Unfiltered, where we analyze weekly income ETFs and faceless finance strategies so you don't have to do the digging. Catch you next week for another ETF breakdown. No fluff, no hype.